Hello and welcome to our latest Insider interview. Today in the studio I have with me Stuart Widdowson, Fund Manager of the Odyssean Investment Trust. Stuart, thanks for coming in today.
Thank you for having me.
So Stuart, to kick off, could you run us through how you invest? I understand that you're looking for mispriced opportunities amongst UK smaller companies. So could you talk us through how you find those potential opportunities?
Absolutely, Carl. So what we're really looking for is a combination of three things. A company we perceive to be of above average quality, a company that's trading below its intrinsic value, or what we believe to be its intrinsic value, and a company that through some management effort could be performing better than it does today. And I think going back to valuation, we look at this in two different ways. The first is this company trading on a discount to what we think its implied valuation is today? And secondly, how is that implied valuation going to grow in time? Now, when we look at valuation, it's not just looking at PEs and many of the metrics that more conventional fund managers look at. We spend a lot of time thinking about who might be an alternative owner to the stock market. And we spend a lot of time benchmarking valuations against corporate M&A transactions. And we found that's a really, really good way to spot valuation opportunities that maybe other people haven't spotted.
It's a very concentrated portfolio. There's currently only 16 holdings. Is that a deliberate choice to be concentrated, or does it reflect the fact that you can't find enough opportunities for the way in which you invest?
So typically we would have up to 20 stocks in the portfolio. Our selection criteria are very rigorous and we're long-term investors, and typically we'd only make 4 or 5 new investments a year. So 16 is probably towards the low end. I think over the last 5.5 years it's been about 18 on average. But what we tend to find is once we have such a rigorous filtering process that there aren't that many companies that pass that test. And once we find those companies that we really like and think we have those prospects, there's a very high bar to find an alternative investment to go and effectively displace one of our holdings.
In terms of your biggest positions, the top 3 stocks, they account for around 40% of the portfolio. How important is it that each of those companies deliver? For instance, if one has a bad year, will that negatively impact the entire performance of the investment trust?
Well, it's a factor that quite concentrated portfolios can have quite lumpy performance both on the up and down side. We tend to find over the long term, if we've selected the right types of companies, the lumps and bumps tend to even themselves out. What we do have with a number of these companies, particularly in our top 3, is whilst they are a single trading entity, they might have multiple divisions that do quite different things. So you are getting diversity of operational performance despite the fact it's just in one company.
And could you run through each of those 3 companies and explain why they are your favourite stocks?
Absolutely. So the largest holding in our portfolio at the moment is a company called Ascential, which is a B2B media company. Now, we invested in this company mostly in Q4 2022. Ascential has had three divisions at the time: an events business for business events, largely in the 2 brands of Money 2020 and Cannes Lion. These are both excellent events and very, very well thought of in their sector. The second division it had was a company called WGSN, which it still has at the moment, but that is currently up for sale or has been sold. That does effectively consumer research on a subscription basis. And the final division, which they had at the time, which they've just sold, is their digital commerce business, which basically helps brand owners sell their items on platforms such as Amazon, effectively electronic platforms. Now, when we invested, the shares had derated significantly, despite the company actually outperforming or meeting expectations. And we felt when we invested at just over £2 a share, the breakup value of the company was way above the share price. So as in, if you added the valuation of all those 3 divisions together, you came up with a share price significantly ahead of where the shares were trading. Now, a few months after we invested, the company put a statement out saying it was going to sell WGSN. This was in January last year. And then in the autumn, they actually announced they'd sold, on the same day, they announced they'd sold WGSN and also sold the digital commerce business to Omnicom. And the shares have performed particularly well over the last year. The opportunity there is really what's left with the events business, because even though the shares have performed quite well, the events business is still being valued, we think, on a look-through basis at significant discount to M&A multiples in that sector. So although it's done very well for us, we still think there's quite a lot to go. The second biggest holding is Elementis, which is a niche specialty chemicals business. And it's a very unusual asset because it is vertically integrated, so it owns a lot of its own sources of raw material in the form of the world's only commercially viable and highest quality hectorite clay mine in California, which has decades worth of supply, and also industrial talc mines in Finland with very, very high quality talc there. Now, the real advantage of that is they take effectively the raw materials and turn them into products to then sell to a whole bunch of different end markets, particularly personal care, coatings or paints industry, and other industries. Being in control of your own raw materials is a fantastic way of combating inflation, because you're much less exposed to third parties increasing the cost of your materials. So Elementis sits in a really, really good position at supply chain and has decades worth of mineral asset backing. It's not just about that opportunity. We bought very well initially during COVID, actually, at a price that was about 50% of, or less than 50% of book value. But we've always felt there was an opportunity of the company to generate higher margins than it has done in the past. And interestingly, the company had a capital markets day in November where they unveiled $30 million of structural cost savings, and the current profitability of the business is about 100 million. So clearly, even if volumes don't improve from this level, which they think it probably will, there's significant earnings upside, which we don't think is in the share price, from delivering those cost savings over the next 2 years. It's also been subject to M&A interest over the last few years, and in late 2020 and early 2021 it was approached publicly by 2 US peers who were interested in buying the company at a significant premium to the then share price. So we think it has really a mix of everything we like: good asset backing, scope to improve earnings, pretty undemanding valuation, but also the upside from some sort of corporate activity if the stock market doesn't value it properly. And the third holding is NCC, which is a technology services business which has 2 divisions: a software escrow business and then a cybersecurity consulting business. Very different businesses, very different dynamics. The software escrow business is a relatively low growth business, almost like an insurance business, where if you buy a piece of software, they will protect the source code in case your software provider goes bust. It's a very stable business. Never going to shoot the lights up, but a very, very good cash generation, very profitable. The cybersecurity business is in clearly a very interesting part of the market. We all read about cybersecurity and the increased threats. It had quite a difficult year last year because early in January and February, some of its biggest US customers were having cost cutting, so the likes of Meta and Google and Facebook, and the company profit warned. We had a small stake in that business that we had left. We've owned it over the years. And in the aftermath of that, we significantly increased our stake by about 3 or 4 times because we felt, again, the shares had basically corrected to a level that was a massive discount to the sum of parts. The team is doing a really good job in refocusing the business and taking cost out. And we think some pretty exciting times lie ahead for the business. We wouldn't be surprised to see the business separated into 2 different businesses at some point as well.
So the investment trust, it's been around for nearly 6 years. Mm-hmm. So of those 16 current holdings, how many have you had since IPO?
So it took us about a year to get invested post-IPO. We have 3 holdings that are still in the portfolio from the initial investments we made. The first is Wilmington, which we've almost exited, actually. It's a small B2B media company. We bought in the day of a profit warning at a very undemanding valuation, and a new team has gone in there. Again, common theme here, change management, our portfolio companies. A new team has gone in there and really focused on the portfolio. They've sold some slower growth, less core assets, made a couple of quite interesting bolt-ons. They've paid a lot of debt down, and they've structurally improved margins and moved a lot of the training business from face-to-face to online as well, which was really accelerated through COVID. It's done very well for us. We've largely exited the position, but it's delivered annualized returns of about 15% in a market that's been flat for the last 5 and a bit years. The second one is Chemring, which actually we did fully exit post Ukraine, and we bought back in more recently. This is a niche FTSE 250 defence company, most well known actually for countermeasures, but increasingly it's being recognised. It has again an electronic warfare and cyber and AI business in there. We exited it when the Ukraine war kicked off because the stock market, as you remember, was pretty difficult through that period, and Chemring actually significantly re-rated by about 30 or 40%. And we felt that was an exuberant response to what was happening in the Ukraine, and we exited the position and reinvested the money in the rest of the portfolio. But as that exuberance faded over 2023, we felt the stock became quite undervalued again in Q4, and we bought back into it. The final one is a company called Benchmark, which is a niche aquaculture business, which effectively is the technology around the nutrition and breeding and treatment of salmon, typically. So it's involved with specialist feed for very, very small salmon as they're growing, genetics for salmon egg, basically creating disease-resistant salmon eggs, and then finally a system to basically help treat sea lice in salmon farms, which is one of the biggest costs to the industry.
When you're constructing the portfolio and you're on the lookout for potential new names to enter the portfolio, how important is looking at sectors, and how much store do you set by themes?
Absolutely. So very similar to private equity. So Ed, my colleague, and I used to work in private equity. We believe in focusing your time and energy on a small number of sectors and getting to know those sectors much better than trying to invest in the whole market. So we really focus on specialist industrials, TMT, healthcare and business services, and that accounts for the vast majority of our portfolio. And we feel that if we understand those sectors better, we can spot valuation opportunities, but also in the case of Elementis and some of our other holdings, situations where companies are not making the profit margins we think they should be, and really trying to spot that before the market does.
Stuart, thanks for coming in today.
Thanks, Carl.
So that's it for this episode of our Insider Interview video series. Check out the rest of the series on our YouTube channel. Please let us know what you think. You can comment, like, and please do hit that subscribe button. And hopefully, I'll see you again next time.